The stock market is like a race car. It's a high-speed, high-stakes environment where every second counts. But just like a race car, it can't go full speed all the time. There are moments when it needs to slow down. Last week, the market zoomed ahead, reaching new highs and creating a buzz of excitement among traders. This week, it took a breather. That's normal. It's a natural part of the market's rhythm. This pause gives everyone a chance to catch their breath, to reassess and recalibrate their strategies. It also lets us see where the market might go next. Analysts and traders use this time to study the trends and data. Think of it like a pit stop in a race. The driver gets a drink, rehydrates, and prepares for the next stretch. The crew checks the engine, ensuring everything is in top condition. They make sure everything is running smoothly, fine-tuning the car for optimal performance. That's what's happening in the market right now. Traders and analysts are taking this time to review and strategize. Investors are looking at the numbers, trying to make sense of the recent movements. They're trying to figure out the best moves for the future, planning their next steps carefully. This pause doesn't mean the race is over. Not at all. It's just a temporary slowdown. It just means we're getting ready for the next lap, gearing up for the next big move. And trust me, it's going to be exciting. The market is always full of surprises and opportunities. To understand the market, we look at something called indexes. They're like scoreboards that give us a snapshot of how the market is performing at any given time. Just like in sports, these scoreboards help us keep track of the action. They tell us how stocks are doing overall, providing a broad view of the market's health and direction. By looking at these indexes, we can gauge investor sentiment and market trends. Three big ones are the Dow, the S&P 500, and the Nasdaq. Each of these indexes has its own unique characteristics and focuses on different segments of the market. The Dow is like the all-star team. It tracks 30 big companies, often the most influential and established in the market. These companies are leaders in their industries. It tracks 30 big companies, giving us a sense of how these major players are performing. When the Dow moves, it often reflects broader economic trends. The S&P 500 is like the whole league. It follows 500 companies, big and small, across various industries. This makes it a more comprehensive indicator of the market's overall performance. It follows 500 companies, big and small, providing a broader view of the market. This index is often used as a benchmark for the performance of the entire stock market. The Nasdaq is like the tech team. It focuses on technology companies, which are often more volatile but also offer high growth potential. It focuses on technology companies, capturing the performance of innovative and fast-growing sectors. This makes the Nasdaq a key indicator for tech investors. These indexes went up last week, reflecting positive market sentiment and strong economic data. But this week, they took a little dip. That's okay. Market fluctuations are normal and can be influenced by a variety of factors, including economic reports, geopolitical events, and investor sentiment. It's like a basketball game. Just as teams have ups and downs during a game, the market experiences its own highs and lows. One team might be ahead at halftime, but that doesn't guarantee a win. The same goes for the market. Short-term movements don't always predict long-term outcomes. But the game's not over yet. Just like in sports, it's important to keep an eye on the long-term performance and not get too caught up in short-term fluctuations. Inflation is like a party pooper. It means prices are going up. When prices go up, people can't buy as much stuff, and that can slow down the economy. Investors watch inflation closely. If they think inflation is getting out of control, they might get nervous. They might sell stocks, and that can make the market go down. Right now, inflation is still a concern. But it's starting to cool down a bit. That's good news. It means the party might keep going. Trade is like making deals. It's a complex dance of negotiations, agreements, and sometimes disagreements. Countries buy and sell things from each other, exchanging goods and services across borders. This global trade is essential for economic growth and development. When trade goes smoothly, everyone benefits. Businesses thrive, economies grow, and consumers enjoy a variety of products. But sometimes countries disagree. They might put up barriers to trade like taxes, tariffs, or quotas. These barriers can make it harder and more expensive to trade, and that can hurt the economy. Higher costs can lead to lower trade volumes affecting businesses and consumers alike. Investors keep an eye on trade deals. They analyze data and monitor market trends to make informed decisions. Good deals can boost the market, leading to higher stock prices and increased investor confidence. But disagreements can cause problems. Trade disputes can lead to uncertainty and volatility in the markets. Right now, there are some trade tensions around the world. These conflicts can escalate and impact global trade dynamics. That's something to watch closely. Analysts and traders are constantly monitoring these developments. It could affect the market's next move. Uncertainty can lead to cautious investment strategies and market fluctuations. So, there you have it, the intricate world of trade deals and disagreements. The market took a breather this week, reflecting on the ongoing trade discussions. But the race isn't over. The global market is always in motion, with new opportunities and challenges. Stay tuned for more exciting action. We'll keep you updated on the latest developments in the world of trade and finance. As we wrap up this week's insights into the world of trade and finance, it's clear that the landscape is ever-changing. Deals and disagreements shape the market, and staying informed is crucial. Whether it's trade barriers or new agreements, each move has a ripple effect on the global economy. Remember, understanding these dynamics can help you make better investment decisions and stay ahead of the curve. We're committed to bringing you the latest updates and in-depth analysis, so you can navigate these waters with confidence. Thank you for joining us. Don't forget to like, share, and subscribe for more insightful content. See you next video.